Yeah, let's move on, okay? Ready for the next step? Okay, what did you notice about this that was unrealistic about these companies that we've worked with so far? It was too easy. Yeah, they're rounded to dollars, and quite frankly, a lot of our numbers are rounded to even dollars just to make them easier so that we're not dealing with the pennies and stuff like that. Okay, now, I don't know if you heard what Carol said, but she said the T's are all blank on the other side. And that's the reason why that is because so far our companies have only made deposits, right? They've only increased the bank account so far. Everything's been an increase to the bank account. We've only increased accounts receivable. We've only bought inventory or furniture. But we haven't gotten rid of anything, have we? And that's really unrealistic, isn't it, from the real world? Obviously, we can make a lot of deposits, and we like to make those, but we're also going to reduce the bank account as well, aren't we? Now, asset accounts, are they debit or credit accounts? Debit, because they show what we got, right? And so if we want to enter something into an asset account, increase that asset account, we're going to debit it, right? How do you think we decrease an asset account then? We credit it. A credit to an asset reduces the balance in that asset account. So any entry on the credit side of an asset account reduces the balance. So we have additions, we have subtractions. Okay? Now what about liability and capital accounts? Are they debit or credit accounts? They're credit accounts. So if we want to increase a liability or capital account, we're going to credit it. Correct? If we want to decrease a liability or capital account, what are we going to do? Debit it. So it's just the opposite. Debits are a minus and credits are a plus in a liability or capital account. Okay? So let's consider this for a moment. Let's say that we buy inventory on a 30-day account. Okay? What is the entry going to look like when we originally buy that inventory on a 30? It's $10,000 worth of inventory. Got an account down here called inventory. Okay. What are we going to debit and what are we going to credit in that entry? Debit inventory, $10,000. Okay. And we're going to credit accounts payable, $10,000, right? Okay. Thereby increasing inventory, correct? And we're also increasing our liability for what we owe, okay? Now, 30 days goes by. We're going to pay off that $10,000 liability. We're going to write a check for $10,000, okay? Now, in this case, we're going to take an asset and we're going to pay off the liability, right? So we're going to decrease our bank account, correct? So here's our bank account. We're going to debit or credit it? We're going to credit the bank account, $10,000. What are we going to debit? Accounts payable, because we're paying this off, right? After we make this entry, what is our balance in accounts payable? Because it's all paid off. We no longer owe it, right? This $10,000 cancels that $10,000. This plus is offset by this minus, okay? So that's how, now in both cases we decreased accounts, didn't we? We decreased an asset account and we decreased a liability account. Once with the credit and the other with the debit, okay? So that's why it's so important to understand which accounts are debits and which accounts are credits so that you know which one, how to increase one account and decrease that same account with which sign, okay? So for asset accounts, we always increase them with debits, decrease them with credits. Now, we've got another practice set that we're going to work on together up here. If you would take another one of the T account sheets that you have, the ones that I handed out to you, you might recall that when we talked about putting together a puzzle, couple days ago, we discussed the fact that what's the first thing we do? Parameters. And what do the parameters represent in accounting? The general ledger. So we do the general ledger. We're going to fill out and establish the accounts first in our general ledger. So the accounts that this business will need begin with a bank account in the current assets. We're going to sell to customers on account, so we need to have an account that says accounts receivable. We know we're going to have to get some utilities set up and rent and so forth, so we're going to set up an account for prepaid deposits. We will even allow some customers to buy things from us and make us monthly payments, including interest. So what account is that? Notes receivable. So we're going to have that account. And since our purpose is to sell both services and product, we're going to need one account for inventory. So skip a space and in the larger T account, write inventory. Under the fixed asset account, we've got one called furniture. In the liability section, we have accounts payable because we've got some vendors and suppliers that we're going to buy from on credit. So we're going to need an accounts payable liability. We have to, when we sell product, we have to collect sales tax. So we're going to have a sales tax payable account. We're going to have some employees, so we're going to need a bunch of withholding taxes. FICA payable will be one, and that's for both Social Security and Medicare, FICA payable. Federal withholding payable will be for the federal withholding tax that we withhold from our employees. And our state also withholds state withholding tax. So we're going to have a state withholding payable. Okay? Under the accrual section, we're going to have an account called accumulated depreciation furniture. See, if we have a fixed asset account furniture, we need to have an accumulated depreciation furniture as well. There will be a one-to-one relationship. For every fixed asset account, we'll have an accumulated depreciation account, except for what? Land, because we don't depreciate land. Okay? Under the capital section, we'll have owner's investment. The next one will be earnings. And the last one in this capital section will be what? Owner's drawing account. Owner's drawing account. Now, owner's investment and owner's equity are the same account. It's just the first year we usually call it owner's investment, and then we just adjust the title to owner's equity. What type of legal structure is this company? Sole proprietorship. It's got the accounts for sole proprietorship in the capital section, right? Okay. If this were a corporation, what would those accounts be? Common stock, retained earnings, and earnings. Okay? Okay. Questions on this so far? Let's go ahead and get into some of the transactions. The first few transactions by now have become fairly mechanical for you, but we need to set up the balances in the account. So we got to start from day one. When they first started the business, this was a furniture business. They started it with a $20,000 investment, put it in the bank. So make the entry to record the $20,000 investment in the bank. Okay, Joanna, what'd you do? Very good. Debit the bank $20,000. Credit owner's investment $20,000. And it will really be helpful if you'll make sure you put those numbers, those cross-referencing numbers in there, because at the end of this, you might not be in balance. This one will get a little bit more complicated, and it's easier to find you're out of balance if you've got the cross-reference numbers. Number 2, we need to get some inventory in our business, so we're going to purchase $10,000 in inventory on a 30-day account. Purchase $10,000 in inventory on a 30-day account, meaning that we'll pay for it in 30 days. We're not paying for it right now. Okay? Richard, what'd you do? Good. Very good. Debit inventory, $10,000. Credit accounts payable, $10,000. May I also suggest that you write the number small in the liability side? It gets fairly tight for them in there. One other thing I wanted to ask you, when do you think we record that entry for $10,000 on a 30-day account? When we make the phone call and order it? Is that when we record it? When do we record it? When we receive the goods, right? Because there's been no liability assumed nor sale made on their part until the goods are delivered, correct? So we might make a notation on a purchase order or something like that that we've made the phone call, we've ordered it, but we're not going to make the accounting entry until we actually have the goods in hand. Okay? Number 3. All right, check number 101. Buy $5,000 in inventory with a check. Okay, now think through this process. Think, what did we get and where did it come from? We paid $5,000 by writing a check and we got inventory. So make the entry to record that check. Okay, Sandy, what'd you do?
I debited the inventory $5,000 and I credited the bank account.
Very good. Debit inventory $5,000, credit the bank account $5,000. We simply took one asset and converted it into another asset. Is that correct? Both entries were in the asset section. We still have an asset. It's just in a different form than it was before. Do you follow that? It was money, now it's inventory. What happened to our working capital with this entry? Think about it. It didn't change. Because both assets were current assets, weren't they? So we converted one current asset into another current asset. So working capital did not change in this entry. Do you follow that? Okay. Number 4. We move furniture inventory, which cost $2,000, into the office to use. So we had some stuff, some desk and chair, that we intended to sell at one time, but then we decided we liked it so much we put it in our office to use it. So we took the price tag off of it and moved it back there. Okay, think, what did we get and where did it come from? Okay. Kathy, what'd you do? Okay, debit the furniture, fixed asset account for $2,000. Good.
And credit inventory for $2,000.
Very good. credit furniture or debit furniture. That's what we got. We got furniture that we're going to use, and credit the inventory account because we took it out of there. It was among this $15,000 worth of furniture that we bought. So we're going to decrease it and change its use. What happened to working capital with this transaction? It changed, didn't it? Why? That's right. We took a current asset and we turned it into a fixed asset. One of the bigger mistakes that new businesses do is they take current assets that should be at a premium that they need, and they say, well, I got all this money, I'll go ahead and buy some equipment. And if they have adequate funds, that's no problem, but sometimes they cut themselves short. They don't realize the debts that they're going to have, and they take a current asset and turn it into a fixed asset. Okay? We credited inventory, $2,000, because we took it out of there, and we turned it into a fixed asset, okay, which is furniture. Okay? Everybody clear on that entry? So again, total assets didn't change, did they? But current assets did. Current assets went down, so working capital dropped as well. Okay? Number 5. Oh, we love these. These are as difficult a transaction as you will run into out there. Whenever you sell merchandise, you've got two parts to the transaction. Individually, they balance. Now, I want you to do it the way I show you to understand this. Otherwise, you will be confused. I want you to, this is the transaction. We're going to record it. We're selling furniture for $2,000, plus we have to add another $200 in sales tax. The customer gives us $2,200 and we put it in the bank. Okay? Now, we're going to treat that first part of the transaction just like we did when we performed a service earlier. Okay? So forget the fact that inventory is involved. Ignore that. As if we're simply entering in the service, the performance of a service, okay? And it's going to go in just like you've done before. What did we get? $2,200. Where did it come from? $200 came from sales tax, and we earned $2,000. Go ahead and enter that into the books. Forget inventory for a moment. We'll come back to that in a second here. More people struggle with this one transaction than any other transaction out there. So the earlier you can get this understood, and if you break it down in two pieces, it really helps, the better off you will be, okay? So think, first of all, what did we get? $2,200, where did it come from? Enter that in. Let's go to that point so far. Okay, Patricia, what did you do so far? Tricia. Okay, you debited the bank account for how much? $2,200. $2,200, good. Okay, we're going to go ahead and credit sales tax payable $200 because that's right. But let's talk about the accounts payable. Do we owe anybody anything here? We've already performed the service, haven't we? And we've earned the $2,000. So what are we going to credit? Credit earnings, okay? So down here under earnings, we've earned $2,000. So does that balance? Okay, we got a debit to the bank account for $2,200. That's what we got. Where did it come from? $200 was from sales tax, and $2,000 was we earned it. Okay? Does that make sense, Trish? Okay. Now, that's the first part, and it balances. Whenever you sell merchandise, however, you have to consider the effect on inventory as well. And if we go back to this transaction, we'll see that the cost of the inventory that we sold was $1,500. Now, it doesn't surprise you that we sell it for more than we paid for it, right? Okay? How much, okay, now it's inventory, right? So it's over here, right? How much is it in this account at? Is it in here at $1,500 or $2,000? $1,500, the original cost, correct? So if we get rid of it, we need to take it out of inventory, don't we? Okay? And we're going to take $1,500 out of inventory. Trish, how are we going to reduce inventory? With the debit or credit? Credit. So let's credit inventory $1,500, getting it out of there. Okay? So now it's out of our inventory account because there's a customer running around with it. We don't have it anymore, right? Okay, let's look over at the other side. Where's the debit? How much profit did we make on that sale? How much did we actually earn from that sale? Not 2,000, right? 500. Okay? Right now we're saying we earned 2,000. So what do we need to do to adjust the earnings account to show what we really earned? Debit it $1,500, right? Do you see that? Now our earnings went up by 2,000, but they went back down by 1,500, right? So the net impact to earnings is $500. Okay? So if you'll remember those two parts, first record the sale. There we got it. 2,200 debit, 200 sales tax, 2,000 earnings. Okay? That's done. That balance. Then record the cost of that sale, and it will always look the same. Credit inventory, debit earnings. Always look the same. Yes?
Couldn't we have just debit or credited earnings for 500?
We could have, it would have impacted earnings the same way. The question is, could we have just credited earnings for 500 and had the same impact? Yes, the answer is earnings would have been hit by the same thing, but you'll see tomorrow we're going to explode this earnings account. And then it's got to be two separate entries. So let's get in the habit of doing that now, okay? It's also easier to remember if you'll do it in two parts. If you net it out, sometimes it gets a little bit clouded in your mind. You're trying to think, now what was I supposed to do? Just sell it, show as a sale one time, and show it as a cost of sale as the second part of that entry, okay? Let's try it again and see if we can do it. Number 6. This one's a little bit more interesting. We sold furniture inventory for $5,000. Plus, we added $200 in sales tax, so that's a total of $5,200 that the customer owes us, right? They gave us $1,200 in cash, and the rest they're going to pay us over a period of 12 months plus interest, okay? There's going to be interest involved. Is that important to note that?
Yes.
Now, ignore interest as far as calculating. You don't need to calculate it now because we don't recognize interest until time has passed, okay? So all you got to know is that this is an interest-bearing receivable, right? Okay? Now record that part first as an entry. So record the $5,200 first. Then, as a second part, record the cost of the inventory sold, and it was $3,000. Okay, so record it as two parts. We sold the furniture for $5,000, plus we had to charge them $200 in sales tax. That was $5,200. From them, we got $1,200 in cash, and they signed a contract that we're going to collect on for the next 12 months, which also included interest for $4,000. The cost of the merchandise was $3,000. Okay, we got $1,200, so we're going to debit the bank. That's what we got, right? Where'd it come from? Okay, finish that, the debits, I guess.
Debit notes receivable for 4,000.
Okay, so we got those two things, right? That's a total of $5,200, correct? That's what we got. Now, where did we come from?
Okay, I credit sales tax payable for 200
Good.
and credit earnings for 5,000.
Excellent. Does that balance? Okay. We got two things. We got the bank account. We got notes receivable, $5,200 in debits. Where'd it come from? $200 from sales tax, $5,000 we earned, so we got $5,200 in credits. That balances. That's the first part, right? Okay. Now let's record the cost. So Kathy, tell us what you did for the cost.
Credited inventory for 3,000
Good.
and debited earnings for 3,000.
Excellent. Okay. So we took inventory. We took $3,000 out of inventory, and we charged it to earnings. Why? Because how much did we actually earn from this sale? $2,000. Everybody with me? Okay. Let's go to a different type of transaction. You'll have several examples of these in the upcoming work that we'll do individually. So you'll have a chance to go back on that again. Recognize that whenever you sell merchandise, you have two parts. First part to record the sale, the second part to record the cost of that sale. And both of them balance. Okay, we got employees that keep asking us for a paycheck. We gotten to the point that we better give it to them, okay? Or else they're not going to come in tomorrow. So, here's an employee that earns $1,200 gross wages, but because they're an employee, we have to withhold taxes from their paycheck. So we're going to withhold from FICA, or from the $1,200, we're going to withhold FICA tax of $100, federal withholding of $200, state withholding of $100, and that leaves a net check of $800. Okay? Now the check is only $800, but the cost of the employee is $1,200. Now let me tell you something before you make this entry. When we make a sale of a service or product, what account do we credit? What account do we increase? Earnings, right? Okay? Whenever we perform a service for them, we earn the money, right? Are there costs associated with making that profit? Is one of them salary? Okay? Now, the earnings account is called the net profit because it shows how much we earned in total after adding all the sales and subtracting all of our costs of doing business. What's left over? Okay? And that's what we've earned. So if we've got a sale, we're going to credit. If we've got a sale, we're going to credit earnings. If we're going to consume something in order to get that sale, we're going to debit earnings. Okay? So this is consumption. And anytime we consume something, it's going to be a debit to earnings. See, when we sold merchandise, in order to make that sale, we had to give merchandise away. We had to consume that inventory, didn't we? And so we increased earnings by making a sale, crediting it. And any times we use something up in the process of making those sales, it's consumption, we debit it. Okay? Now, when we pay somebody for the time expended, we're buying their time. We're consuming their time, and we're paying them a paycheck to get that time, right? But once it's done, it's used up. We can't go back and get it. There's nothing left in the corner of it. It's used up. It's gone. That's consumption, okay? So, with that in mind, let's look at this paycheck together. This employee earned $1,200. We only paid him $800, but he earned $1,200. It just means that we're the middle person. We have to collect all these taxes on their behalf, right? Okay? So let's go to our T account sheets here, and let's figure out what are we going to do. Well, first of all, we know we got a net check of $800, right? So what are we going to do to the bank account? Credit the bank account $800. Okay, that was pretty easy. Okay. How much did this employee actually cost us in total? $1,200, right? We've consumed $1,200 worth of his or her time, correct? Whenever we've got a consumption, what do we know we're going to have? Debit to earnings for $1,200. Now the difference between what we've consumed of this employee's time and what we paid this employee are withholdings. And when we withhold money from a paycheck, we have to pay it to the state or federal government, right? How much did we withhold from FICA for FICA tax? $100. So we're going to create a liability by withholding that, and we're going to credit FICA payable. How much did we withhold in federal? $200. So we're going to credit federal withholding payable $200. And how much did we withhold in state? $100. So we're going to credit state withholding payable. Does everybody see that? Does that entry balance? We got $1,200 in debits. That went to earnings because we consumed their time. Where did it come from? $800 from the checking account. $100 because we promised to pay FICA payable on FICA taxes and federal taxes and state withholding, with a total of $400 that we credited to a liability accounts. Okay? And that balances. Everybody with me? Now I'll give you a chance to try it. Here's a second employee, okay? This second employee's total salary is $800. We withheld $100 in FICA, $100 in federal, and $100 with the state, leaving a net check of $500 that we wrote to the employee and gave to the employee. Okay. Who thinks they've got it? Okay. Everybody thinks they got it? I hope everybody's got it. Okay. Tammy, tell us what you did. Credit the bank account 500. Good.
And then I credited FICA 100,
Good.
federal 100,
Good.
and state.
Good. And then?
And then I debited the earnings for 800.
Very good. Okay. Now remember, anytime we consume something, it's a debit to earnings, right? Okay. Let's look at the next one. You probably knew that when your employer withholds FICA taxes from your paycheck, the employer has to match whatever he or she withholds from your paycheck and send it to the government. So, we've withheld from our two employees $200 in FICA taxes. But how much do we truly owe the government for FICA taxes? $400. So we need to record an additional $200, show that we owe. We're not going to pay it. We're simply going to recognize that we owe an additional $200 to FICA tax. And that's all part of the cost of having those employees. So the entry in number 9 is to set up the matching FICA amount of $200. And when it says set up, it doesn't mean pay. It simply means recognize that we owe $200 more than we're currently showing. So what should the balance in FICA payable be when you finish this entry? $400. Okay? So make the entry. It records both a debit and a credit. The debit is just part of the cost of having the employee. Okay, Carol, what did you do?
I credited FICA payable for 200
Good. Credit FICA payable, $200.
and debited earnings for 200.
And debit earnings for $200. Very good. Because the cost of having those employees, what we have consumed is more than just their gross salaries. There's also taxes involved. And as we'll talk about next week, you'll find that there's a lot of taxes involved. And many of the taxes that employers have to pay, you never get involved with at all. They just have to take it out of their own pockets. So taxes can be a fairly significant issue to employers. The only one that we have to match, however, is FICA tax. That includes both Social Security and Medicare. And the employer has to match those. Now, number 10, let's write a check to pay off both our FICA and federal withholding. One check will pay off both. So write a check, figure out how much we owe them, and then write a check to pay them off. Okay, Dixie, what'd you do? Okay.
I debited FICA for 400 and debited federal for 300.
Very good. Credit the bank $700. That's the amount of the check. That's how much we owe in federal and FICA. Debit the FICA payable account for $400, reducing it. And debit federal withholding $300, also reducing it. Now, what's the balance in FICA payable after making this entry? Zero, because it's paid off, right? What's the balance in federal withholding payable after making this entry? Zero. Okay, so those will be zero. Okay. Let's also pay off the state withholding. So write another check to pay off the state withholding tax. Okay, Nikki, what'd you do?
Credited the bank account 200,
Good.
and I debited the state payable.
Very good. Credit the bank account $200, debit state withholding payable $200. Okay, number 12. Let's write a check to pay the monthly rent. Now we're going to consume the rent. It's used up. It isn't left over. We're writing a check to pay for it. We're using it up to make a sale. Okay? Got to have it. Got to consume it. Okay, so write a check for $1,000 to pay the monthly rent. Just remember that anytime you have consumption, remember what it is. Anytime we consume something, Sandy, what'd you do? Very good. Debit the earnings $1,000 because we consumed it, okay? And what did we credit? Credit the bank account for $1,000. Excellent. Okay? Wrote a check for rent. Rent was gone. It's history. If we had paid the rent in advance, if we had paid it for the next 6 months, or if we had made a deposit, it would still be an asset account, wouldn't it? Because we still haven't gotten the benefit of that rent. We haven't consumed it. We've just given it to them in advance. Isn't that right? But in this case, we consumed the rent. It's for this month. We're using it up right now. And so we're consuming it. In order to make these sales, we had to have some place to rent. So it was a cost of making those sales. Okay? Number 13. The owner wants some money now. Now that she's paid her employees, she wants to keep some money for herself. So she writes a check for $2,000, which she's going to use for the groceries and her rent and all those other things that she needs personally. Check for $2,000. Okay, Julie, what'd you do?
I credited the bank 2,000 and debited owner's drawing 2,000.
Very good. Credit the bank, $2,000. Debit owner's drawing, $2,000. Okay? Number 13. Credit the bank, debit owner's drawing, because the owner took it out of the business. If they're going to put money into the business, it's going to be a credit to owner's investment, right? If they're going to take money out of the business, it's going to be a debit to owner's drawing. Okay? Number 14, we need to depreciate the furniture. This entry always looks the same. Every month we make this depreciation entry, and in essence, we are consuming part of the value of that furniture. We're consuming a portion of that furniture every time we make this entry. We're using a little bit more of it up, aren't we? Okay? So it cost us originally $2,000, is that right?
Right.
We're just taking a little bit of that value down every month. We're consuming a portion of it every single month. Entry always looks the same. You can memorize this entry. The only thing that will change is the amount. Let's talk about that for a second. When we consume something, what do we know we're going to debit? We're going to debit earnings because there's consumption, okay? And you might recall from the board on the debit side, anytime there's consumption, it's going to be a debit to earnings. If we're using it up like rent or inventory, whatever we're using up in order to make sales, it's going to be a debit to earnings, okay? And in this case, we're using it. We had to have this furniture, and over a period of time, we're going to use this furniture up, right? So we're going to do it little by little with depreciation. And so we're going to debit earnings $100, okay? Each month, we're going to debit it. 14. Okay, however, we don't want to credit furniture because we don't reduce the fixed asset account unless what happens? Unless we physically dispose of it. So it's going to stay in the books at $2,000 until we get rid of it. It never goes down. But instead we have another account to carry that depreciation, and it's over in the accrual section, so we're going to credit accumulated depreciation, $100, okay? So we debit earnings, we credit accumulated depreciation. Every month we do that, okay? It's just a regular standard entry that we make every single month. And next month when we make the same exact entry, we're going to add another $100 to this, right? And at that time, the balance in here will be $200. What will be our book value of that furniture at the end of that second month's entry? $1,800, right? And next month, we're going to add another $100 to accumulated depreciation. What will be the book value at the end of that entry? $1,700. So what's going to happen is, original cost, $2,000, is going to stay right here until we physically dispose of it, right? And then every month we're going to increase accumulated depreciation until at some point, accumulated depreciation and the original costs are the same. And then what's the book value? 0. You see how that works? Okay? Yes. Any questions? What's the purpose of making that entry? To show what our true costs of making the sales are, to show what our true profits are. Okay? We bought that furniture when we started. Okay? Are we going to get the benefit of that furniture over a period of maybe 2 or 3 years?
It's gonna cost less.
Okay, but are we going to get the benefit? I mean, we bought that furniture to make money with, right? We had to have furniture in our office in order to be able to do the sales and things, and we had to have that. Well, it didn't cost us $2,000 just to make the first sale. It cost us $2,000 to make the next 2 years of sales, right? So we're going to have all this sales coming in. It would be unfair to show profits dropping $2,000 in the first month when you're going to get the benefit of that furniture over the next 2 years. So what we do is we reflect it in earnings little by little, okay? Better example, delivery truck, okay? We're going to make money from that delivery truck for the next 5 years, right? Okay? And it might have cost us $20,000 when we bought it. It would be unfair to hit that first month with a $20,000 reduction. The profit would be, we'd have a huge loss, wouldn't we? When in reality, we're going to get benefit of that delivery truck over the next 2 years or 5 years of sales. Okay? So we're going to assume just a little bit each time of it. Does that help? Do you understand, Joanna, why we do that? That's why we do depreciation, is to try to recognize the costs of doing business as they apply to the sales that we make. Okay? And it's called a timing. We want to match the timing, the sales with the cost. Okay? Now, those were all the transactions. So our next job is we got to balance these accounts. Okay? Now, remember, under the assets, debits are plus, credits are minus, right? So we're going to add up the deposits, which it looks like are $23,400. Is that right? In deposits. And we're going to subtract all the checks we wrote. Someone could do that math for me. $13,200. Okay. So now we take the $23,400 and subtract $13,200, and what's our balance in that account?
Oh, I'm sorry, that was a balance. I did it all the way.
Oh, $13,200 is a balance. What was our total checks? $10,200. I'm sorry, didn't understand that. Okay, so $13,200 is a balance. Accounts receivable and prepaid deposits, we didn't have any. Okay. We thought we might have them, so we set them up. And maybe next month we will. It's all right to set up accounts that we don't use right now. We don't have to use them all. But later we might have them. So let's go 0 here in those balances. Notes receivable is $4,000. Inventory. We bought $15,000 worth of inventory, but we either used or sold. It looks like $6,500. Is that right? So that means we've got how much in inventory? I think it's 8,500. Is it 8,500? 8,500. And then we got 2,000 in furniture. So to add up the total assets now, and let's see what we've got in assets. What'd you get in assets? 11, what is it? $27,700. Now we go over to the liability capital side. We've got $10,000 in accounts payable, $400 in sales tax payable, 0 in the next 3 payables. We've paid them off. $100 in accumulated depreciation furniture, $20,000 in owner's investment. Now we got to figure this one out. $7,000 in credits, and our debits are going to be 7,800 in debits, is that right? Okay, now hold on a second. What's the balance? That's right. Remember that on this side, the capital side, your credits are pluses, your debits are minuses. So we take 7,000 and minus 7,800, and what do we get? We lost $800 that month. Is that important information to know? You bet it is. Okay. Now, what about owner's drawing? What's that? If we add the credits and subtract the debits, we're going to have 0 minus 2,000, right? So we're going to have a negative $2,000 balance in that account. Okay? So you always got to remember on that right side, we're going to add the credits and subtract the debits. And sometimes our debits are going to be more than our credits, and it's going to result in a negative number. So what's our total liabilities, accruals, and capital now? Isn't that great? Huh? 27,700. Okay? So our assets equal our liabilities, accruals, and capital. Or, another way said, our debit balances equal our credit balances. Okay? Questions on any of that? Does that make sense? Okay. That's a more complete balance sheet you've just completed. Okay?
Complete the student practice sets on pages 5.22 through 5.27. If you need help, the answers are in the appendix on pages 8.9 through 8.11.